What we're going to look at now is specifically we're going to be looking at fixed and floating exchange rate regimes. Now, the reason why we're doing this is really twofold. Firstly, you'll recall that in video number 1, we specifically looked at the opportunity set, as in the set of opportunities that this asset class, the Forex markets, present to us as traders. And as traders, we seek out volatility, and we deduced very quickly that the standard definitions of the opportunity set are in conflict with our own objective, which is to basically make money with our own money. And due to this conflict, we quickly deduced that our objective of seeking volatility requires currencies to move over any time horizon. And we started grouping currencies based on their regime. And we also grouped currencies based on their commodity dependency. So whether they were concentrated dependency or diverse, so not dependent on one or two commodity prices. So the way in which we've started defining our opportunity set is one of the reasons why we're starting to look at fixed versus floating exchange rate regimes, so we can really understand the underpinnings and get a good foundation of understanding as to what the differences are between these regimes and what the nuances are between these regimes. This will allow us to build out our opportunity set more with confidence and understanding. The other reason we're looking at this is, if you recall, at the beginning of the video series, we did briefly mention that the Professional Forex Trading Masterclass, this video series, is going to be as much a lesson in macroeconomics and international trade as it is about trading and portfolio management. And that's really important, because this is what it all comes down to. This is what currency trading comes down to. It comes down to a thorough understanding of the macroeconomic environment. So as we go through learning about the differences between fixed and floating exchange rates, by default, we're going to be learning how macroeconomics actually really works. And that's going to give us a much greater understanding overall in the currency markets, and really help us even much later on in the video series when we start looking at the systematic processes. So there's a lot of information to get through here. So why don't we maximize the screen and start going through the differences between fixed and floating exchange rates. And first we have to look at the history. Okay, so we're going to look at the history of fixed and floating exchange rates, and really the beginning of modern macroeconomics started during the war, during World War II, in 1944 at the Bretton Woods Conference, where there were 44 nations from around the world that met at Bretton Woods in New Hampshire in the US, and they were there to agree upon a series of new rules for the post-war, post-World War II international monetary system. And there was a major problem in the world. Well, there were a few major problems. The first one was an occurrence of the Great Depression in the 1930s, where basically there were reactive, protectionist economic policies brought into force, such as high tariff barriers, competitive currency devaluations, and discriminatory trading blocks brought into force basically in reaction to the Great Depression, which was kind of counterintuitive, because high tariff barriers, for example, is when a country basically puts up tariffs on foreign goods for importers mainly, and that makes foreign goods more expensive relative to domestic goods. And that actually stops or hinders trade, which is counterintuitive to a recession or a depression. What you're trying to do is actually increase the amount of trade and increase economic cooperation and growth. And high tariff barriers are counterintuitive to that. But also competitive currency devaluations, for example, is when a central authority may manipulate the value of their currency lower in order to make their exports cheaper on the international market. And basically, these protectionist policies created a problem in the world in that it created an unstable international environment, and the global economic situation just didn't improve at all. World War II was also a crippling factor. The US and international leaders after World War II basically decided that the only way to deal with these two major issues was further economic cooperation. And this, in turn, would achieve peace and prosperity. So the solution that was put forward was that there was a kind of overriding belief that the system of free trade would promote international prosperity and international peace. And at the Bretton Woods Conference, all of the post-war Allied delegates signed what was called the Final Act, which basically created the International Monetary Fund, the IMF, and the International Bank for Reconstruction and Development. So what was the outcome there? Well, the International Bank for Reconstruction and Development, the IBRD, was given responsibility as a body to provide financial assistance for the reconstruction of the war-ravaged, less developed nations. So given responsibility for the economic development of these countries. The IMF was given a bit more responsibility. The IMF was given responsibility for maintaining a system of fixed exchange rates centered on the US dollar and gold. And they were also responsible for maintaining an orderly international monetary system and the expansion of world trade by providing short-term financial assistance, if it was required, to countries experiencing temporary deficits in their balance of payments. So what do we mean by deficits in balance of payments? Well, if you're a country that imports more than they export, then you're sending more foreign currency abroad than you're receiving currency into your country, and you end up with a deficit in your payments balance. So the idea was that the IMF, if countries saw large shortfalls in payments, so deficits, that the IMF could step in if they wanted to.